Now, here are your hosts, and Michael Hartzman.
Well, good evening, everybody. This is Dom Tavella, and tonight we will not be having my partner, Michael Hartzman, with us. Michael had a little bit of a surgery on his elbow, nothing significant, but he is recovering. And as an alternate, I think a terrific prior guest with us, Phil Blancato, will be a co-host with us tonight, and we'll talk about everything about the markets, the economy. Probably not get to Italian wines tonight, Phil, but maybe we save that for a future date. Phil is the CEO of Ladenburg Asset Management and the Chief Market Strategist for Osaic. I believe that's the new name of the company, right, Phil?
It is. We just recently changed our name. Some of you might remember the name Advisor Group, but Osaic is a wealth management firm with about $600 billion under management that we get to advise on, and financial advisors that we work with, about 12,000 folks. So pretty large financial services firm. We decided to combine the firms together and come up with one new fun name.
Well, congratulations on that, Phil. And you guys have really grown to a pretty substantial firm over the last, not even that many years, right? Maybe half a dozen years or so?
Yeah, really. We just keep getting bigger and bigger and taking advantage of the opportunities in the marketplace. And for us, it's been just a really exciting experience to be part of the growth and, more importantly, help folks manage their money, which is what we care most about.
Well, good luck with that.
Thank you.
So Phil, Mike's not here, and that I like the banter and the back and forth when Mike is. So I'm going to take that role a little bit with you tonight. And by the way, we've got really rave reviews when you've been on with us in the past, and I don't expect tonight's going to be any different. But I do want to take the kind of almost a devil's advocate approach with you tonight, because we get a lot of questions from clients literally daily. They're looking at the CNBCs and the Fox Business and the Bloombergs, and they have their own interpretation of what they're hearing. And I think one of your trademarks is you kind of speak to people in a very calming manner, and no one's 100% right or wrong, but I think you historically have been pretty spot on with your ideas and your thoughts. So I'm really kind of looking to share some of that with our viewers, our clients, and I think the fact that it's the end of the second quarter, maybe the timing of this is pretty good.
For sure.
Joining us.
And I appreciate that. I can understand why this may not feel like a successful market for a lot of folks. We've endless conversations about recessions that haven't happened. And then this oddity of higher inflation and higher interest rates for the first time in maybe, call it a decade, really. And I think folks are a bit confused how the market has climbed the wall worry. So maybe we can have some fun with that.
So let's start. You already hit the first word on my list, recession. The experts have been talking about a recession as almost guaranteed, as almost written in stone. And they've been talking about it, Phil, for 12 to 18 months. And at least through the first 6 months of this year, not even close.
Yeah, to the credit of folks who don't like to use the word, it's different this time. That was the belief going into it, that this time around, the Federal Reserve raising interest rates to combat high levels of inflation, those two painful pills the economies had to swallow, things costing more when you go to the grocery store and trying to buy our money at higher rates, would cause spending to slow down significantly, cause corporations to earn less money, which would propel us into a recession. And the idea was, every time historically when the federal government tried to do this, it led to a recession other than one time. And we call those soft landings. If the Federal Reserve can survive this and not cause a deep recession, it'd be a soft landing. A hard landing would be a deep and wide recession, something akin to 2008, but not exactly the same. So this time, it just doesn't happen. For all the telegraphing that it might happen, why has the playbook not worked? Because I would argue this time it's very different. And the differences are clearly that the U.S. consumer, and when you break the consumer down, you have to think of it in three big buckets. Bucket one, folks under 30, bucket two, 30 to 60, and bucket three, 60 and above. I'll keep it simple. The folks in the second and third bucket are in fantastic shape. And that is clearly the reason why we have not fallen into recession. You see, Dom, We just don't get recessions when people are gainfully employed. And the unemployment market clearly speaks to not only do people have a fantastic job as of right now, because we're seeing folks quit, roughly 4 million people per month quit and go to new jobs. So that means they're taking the opportunity to find a high quality job and they're doing it every single month. Then you go raises. The average person has got anywhere now in aggregate as much as a 20 to 30% raise, depending on how much they made going in. Said a different way, if you made less than $100,000 a year, you've got probably the upside of a 20 to 30% raise in the 2 years combined since the pandemic ended. For example, California dock workers just last week got a 30% pay hike to accommodate for higher inflation. Folks who wash dishes for a living making $50,000 a year are now making upwards of $65,000 a year. So this liftoff has created $2.4 trillion of additional wealth for people who are on that bottom rung of the workforce. So that means the folks that are generally left behind haven't been left behind. The folks that were in that middle bucket that had a good job got a lower raise, but got a raise. And the folks that are older have accumulated the most wealth in human history. Today, we're worth $162 trillion. So even though the Fed has hiked interest rates and we're dealing with some inflation, it's had no effect. We have not slowed down the amount of money we spend from sales and other things we do like travel and leisure. We've bought back all the goods we wanted to buy during the pandemic. So you're seeing goods prices come down significantly. Things aren't nearly as bad as they historically been when the Federal Reserve raised rates. And it's because people have more cash than they've ever had before, more wealth than they've ever had before, a better job than they've ever had before, and making more money. That's not the recipe of a recession, at least not yet. Potentially down the road, nothing deep, nothing wide, but for now, that's not the recipe of a recession.
So, Phil, I did say I was going to play devil's advocate tonight, but those are the exact reasons why some of the naysayers say, hey, wage inflation is not going to go away. It's not going to go away slowly. Core inflation is going to stay relatively high. And that's literally what's going to force the Federal Reserve to continuously raise interest rates, be aggressive in raising interest rates, and maybe not push us over the edge, but definitely to the edge.
We spent a lot of time analyzing core inflation, and I like something called core PCE. So PCE stands for personal consumption expenditures. When you go to a store and you buy milk, it's a part of PCE. There's 148 different factors that make up core PCE. Basically, it's simple. Core PCE is what you buy, what you spend every single day. And to Dominick's credit, that number hasn't come down nearly as much as the Federal Reserve would like it to be. That number was 8%, it's only come down to 5%. Remember, headline inflation was 10, now it's below 5.
And Phil, I can say, beginning of this year was like, what, 6-ish? And it's down to 5 and change. So we've seen it come down, but it hasn't really come down anywhere near as aggressive as the Fed wanted it to.
But here's why I'm not worried about this scenario. Because the amount of money we've gotten to raise has either equal to or allowed us to survive this bout of higher inflation. So yes, folks don't like it, but what's the most important thing in their sphere when it comes to spending money? Gasoline. Gasoline is at or below darn near where we were pre-pandemic prices, around $3 a gallon. So gasoline is no longer a hindrance. If folks got a pretty significant wage, sure, and we know that it's a bit more expensive, but we're also seeing the consumer being much more prudent. They'll go to a big box store. They'll be a little bit more careful where they're spending their money. What they're not on goods, where they're not slowing down is services. So to your point, I think the Federal Reserve is going to continue to hike rates, but the Fed can do a very good job of bringing down cost of goods. What they can't do a good job is bringing down demand for services. And there's a little bit of a tricky situation. First off, it takes 2 full years for Fed rate hikes to really filter through the system. And we're not but a year in. And at that, a year ago, they start year and 3 months. It started in March of 2022. So we're a year and 3 months in from the first hike. But really, I care more about the middle stage of the hike. So I'd say we're only a year in. We have another year to really understand the full impact. And we are seeing corporate earnings now down 2 quarters in a row and probably going to be down a 3rd quarter. So we're seeing that impact there. The Fed has 2 more hikes in them. I think what's called the natural rate of inflation, which is what it costs you to live versus interest rates, they're now equal. And in fact, right now, wages are higher than the rate of inflation. If I just use regular core CPI or headline CPI, wages are now higher than inflation. So that means the consumer continues to be in good shape. The Fed will hike 2 more times to really kind of try to put the nail in the coffin of this, but here's the funny thing. You know, Dom, people sometimes forget where the wealth of the country is. And where's the wealth of the country today? Far and away, and you know this from being an expert in this space, the wealth of the country is with people who are over the age of 60. Remember my 3 buckets. Bucket 1, the millennials, well, they're just getting going. They have lots of debt. Then they're consumers today and they're overweight, so they're doing okay with spending. Bucket 2, the folks with families and growing, they're big spenders, those folks in that 30 to 60 range. But bucket 3 is the important one. With 65,000 people retiring every single day, they're retiring quite wealthy in most cases. And what do they want? They want an economic slowdown a little bit. Why? Because prices come down, but they're not without money. So the folks without money are traveling, go and kind of get on an airline, go to a restaurant, go to a hotel, go on a cruise line. You'll see these bookings are way out, fully booked. It's because we have so much cash, and that demand side of it, the Federal Reserve can't impact it. Those folks are going to spend no matter what, and they're going to keep us afloat. It doesn't mean a roaring economy, but it doesn't mean a recessive one, because there's enough cash in the system to hold us on. And that's the critical difference than other times in the past where it hasn't been the case.
And Phil, when people, your clients, my clients, talk about their wealth, they feel wealthy when they look at their value of their home. And we have not seen, we saw that in 08, where you saw dramatic drops in real estate prices. Not only have we not seen any significant drops in real estate prices, but in a lot of cases, they've continued to go higher. This is, I think, where the Fed is really kind of in a catch-22 situation, where they raised mortgage rates. They thought that would slow down the real estate market. It really hasn't slowed it, and because we didn't build houses for so long. But housing is a powerful driver of our economic growth. So we have this dichotomy where real estate prices haven't fallen. People still feel, relatively speaking, wealthy. Interest rates really haven't had the impact that the Fed thought they would have.
That's exactly right. And I applaud the Fed. I'm probably one of the few who does. I think the Fed did a wonderful job of keeping us out of a very deep recession. I think if you look at Europe and you look at Japan, they are obviously, with their federal governments not being as aggressive as ours was, we didn't have a recession, and they did. Not terrible, but they're all very slow growth economies. And now they're battling much higher levels of inflation than we are. So as of now, until the Fed really sees a breakage from what they've done, I'm going to back them up. But their impact hasn't been nearly as deep and wide. Why? Well, $2.7 trillion was saved during the pandemic. We're still spending that money. They're not going to be able to affect what people spend when they have savings. And here's another very important point, Tom. Because of your point on wealth, specifically homes, if you look at simple, I'm sure you all do this, how much what you're worth and how much you owe. Historically, since 1980, if you look at that average, it's between anywhere from 10 to 14% based on what you're worth versus what you owe. And right now, today, it's the lowest since 1980. Believe it or not, it's only at about 9.5%. So in other words, we're at the lowest, what we call this debt to asset ratio. What I'm worth, including my home, versus what I owe, is the lowest number since 1980. So that breeds to this consumer that's not stressed. Even though there's some talk about credit card debt going a bit higher, sure, there is some of that. But if you look at folks gainfully employed and having savings, we're not seeing any defaults in credit card debt. We're not seeing any defaults in homes. We're not seeing any corporate defaults. Why? Because the economy is healthy enough, because of 10 years of low interest rates and a gainfully employed consumer, to survive this slowing down of the U.S. economy. And it's certainly grinding to a very mild halt. But it's not 2008 where we've got trillions of dollars in default, people walking away from homes, see a real upheaval in the unemployment market. That's not the case this time, at least not yet. And it doesn't seem to be the case because we need more. Just today, you see more jobs open. There are people looking. Corporations have gotten smart. They're reducing the number of hours worked per week, but they're not laying anybody off. Well, that's a good thing because we don't have pressure on the unemployment market. People stay gainfully employed. They still spend. It keeps us alive.
So, Phil, I'm going most of the kind of questions I'm getting from my clients. What keeps the Fed from screwing this up? And I agree with you. I think overall, the Fed's done a relatively good job, but they certainly have within their means to over-tighten, not look forward, but always continuously look backwards. There is that possibility there. You want to address that?
There are some black swans that I think about out there that start with the Federal Reserve. Let's assume they just go too far. Let's assume they push interest rates to 7 or 8% because they're just not slowing down the U.S. economy. That would be damaging because you could create a long-term impact on the housing market and on the bond market, where you have real significant losses for a long time to come. And then to add to that, when loan demand, people borrowing money, banks or corporations, corporations or people, stop borrowing money because interest rates are too high, then you see a real slowing down in the U.S. economy. At the core growth of an economy, we need spending. And spending right now is surviving because of pent-up savings. But when that savings runs out, and that savings will run out at this pace of saving, we'll probably run out of that excess cash by the end of the year. Now we're going to be solely reliant on those wealthy older Americans who are going to spend, which will keep us alive, but not completely. And then that middle group, if they can't borrow to grow or borrow to build, and corporations aren't willing to go borrow money to grow a new factory or whatever the case may be, then we will slow down significantly and have a very nasty recession if the Federal Reserve hasn't gotten out of the way and they haven't accomplished this. The one thing I greatly struggle with the Federal Reserve, and this is a mistake in my opinion, not a lot they've done wrong. I don't think they're going to hike much more. They're talking about 2 more hikes and then stopping to see what the effect they had. They did this last month. They're smart to not hike in June just to see the impact. And you'll probably see them go in July and then maybe pause in August and go in September. That seems a likely scenario. The one thing I'm struggling with is this desire to be back at 2% inflation. I think that's the dangerous mistake that they're making. As long as the trend of inflation continues to go down, and albeit it may not be as fast as we like. By the way you get out of wage inflation is you grow the size of the economy and you keep wages basically stagnant at that point, increasing them 2 to 3% a year rather than 5, 10, or 15. So the size of the business gets bigger, but the wages stay stable. That's how we get back to normal level of wages, and it's already starting to happen. Growth is happening, albeit not as fast, and wages are starting to stabilize. But my point is, this desire to be back at 2%, why? If anyone, I'm 55 years old. If you think about 1980 to call it 2000, make it simple, we were very happy to live with 4% inflation. It was fine. Things ran just well. We had a pretty healthy economy for decades and a roaring stock market, and didn't accumulate a heck of a lot of debt in this country. In the last few years, we've accumulated trillions of dollars in debt to stave off some really bad scenarios, 2008 and 2020. And now we've got to worry about the costs of that debt. And not to mention, we've got to worry about the Fed trying to really go back to some number that's arbitrary. When I think we can be just fine as a country at 4% or lower, as long as the trend continues down. If it takes 3-4 years, remember, every inflationary cycle ended. It just might take a bit longer than they expected this time. And that's where I think they got to be careful about not being too impatient and not targeting some goal that may not really be necessary.
Bill, the next one on my list of worries, we all, whether it's as a consumer, got used to 3% mortgages, but businesses got used to borrowing at exceedingly ridiculously low rates. And we literally have a large portion of corporate America right now that when they have to end up refinancing their debt, they may not be too happy with the rates that they're getting or will be getting. And there's a large portion, maybe a third of the Russell 2000 companies that can't pay the interest on their debt right now. What happens with corporate profits if these rates stay higher?
So that chicken hasn't come home to roost yet. That's a critical piece of this. I don't disagree with you that when they have to refinance, whether it's a commercial real estate that has to renew their lease at a much higher rate, or a company just who has debt out there that have to mature and reissue new debt, meaning Apple issues a bond 5 years ago at 2% interest rates. That bond's a 5-year bond. If it comes due this year, they got to reissue that debt if they want that money at a much higher rates. That means if you're buying a home, everyone, if you're buying a home and you went out and your mortgage 5 years ago was 3% and your mortgage today was 7%, then obviously you have less money to make towards the principal of that loan or the value of the home because you're paying more on interest rates. Same thing with corporations. They'll earn less money if they're spending more money on interest payments. So the biggest corporation in the world is facing this in a way that it hasn't faced in a long time. And to be quizzical, I would ask you who the biggest corporation in the world is, and you won't get this because I'm not answering properly. In my opinion, the biggest corporation in the world is the United States of America, far and away. And if you look at the $31 trillion we have today in debt, we were financing that money for 1.5% 3 years ago. It was the lowest rate in history. So what the United States did was balloon the size of the deficit at exceptionally low rates, the lowest rates in history. Now what's happening, like corporations and eventually people, as interest rates push higher, the U.S. government's feeling the brunt of it. So where we were spending $400 billion a year on interest payments. Today we're spending $800 billion, and soon we'll spend $1.2 trillion a year on interest payments alone. That means the federal government won't be able to spend less money, assuming they don't borrow more, but spend less money to be able to stimulate the economy. To your point, corporations are in that same boat, except corporations were a little smarter than the federal government. The average maturity of federal government bonds is 5 years. The average maturity of corporate bonds is double that, 10 years. So what you see is most of these companies that over the last 5 to 10 years issued debt, they did it to where that chicken comes home to roost 2025 to 2030. So in that 5-year period, if interest rates don't start to come back down, and we see corporations either just not issuing new debt, they mature their bonds and they don't want more because it's too expensive, or they're having to issue debt at higher rates, it means they're going to earn less money, it means the stock market won't grow because corporate earnings are down. So the black swan scenario is assuming the Fed doesn't get out of the way, keeps hiking rates higher. Not only is the federal government not able to spend to stimulate, neither will corporations. So then that means you, the consumer, whether you're trying to buy a car or a house or do a credit card, are going to pay much higher rates for much longer, and you won't spend either. So that older population that's still going to spend because they have money and retired won't be strong enough to keep us out of recession. There's your recession scenario. That they hike rates too high for too long, created too much pain, and that we get into a deep and wide recession. Prices reset significantly, and we start the clock all over again. I just don't think we're there yet.
So, Phil, I agree with you on the corporate side. I hate to say they're smart enough. I think they'll be in tune enough to deal with this change. But you talked on the real black swan, which was government, and they are now financing an insane amount of debt at much higher interest rates. In context, we look at the entire federal spending on defense, and our debt service will be higher than that number, more than we spend on defense. How do we solve that problem? Is it even possible?
And to do that math, we spend $700 billion a year on defense. Soon we'll spend, as I mentioned already, $1.2 trillion. Well, a couple of things I think are interesting. One, we are the best bond market in the world, so we have to make payments on our debt. The whole debt ceiling thing was just a farce. It's whimsical to think we weren't going to make payments on our debt. It's just silly. But in any event, we have to make those payments on our debt. However, something about the debt math is a little bit funky to me. First off, of the almost $32 trillion, let's not forget the federal government owns about $7 trillion of it. So one hand's paying the other hand. I'm going to guess in that scenario, they're going to say, stop paying me. You don't need to pay me on the bonds I own. Why make one part of the government pay it to the other?
Well, the silliness is not only is the Federal Reserve collecting interest on those bonds it's holding, it then returns the interest back to the. If you and I did it, Phil, in our business, I think the police would show up and take us away. But it is a farce. I agree with you that the whole thing is a farce.
So it's really not 31 trillion. It's about, call it 24 trillion, which is the size of our GDP. So when everyone talks about how in debt we are, in fairness, for every dollar we owe, we make about $1. Now, I'm on the camp, if I think about my days of studying Milton Friedman and Austrian economics, that in every scenario, inflation is temporary. We've never had a permanent bout of inflation. And then the reason why is because demographics matter. Demographics, the more the world ages, the more things deflate, not inflate. Older populations need less money to survive, spend less money than younger populations. And if you think about it, places like China are beginning to have a demographic time bomb where 1 billion people are going to be 60 at the same time. Even India, which now passed China from a population standpoint, but will soon begin to trend down, not up. My point is, inflation, specifically because of demographics and technology, think of all the things your phone does for you, that limits the amount of money you spend today, are going to trend back down over time. So I think we will go through a period of slower growth because of the amount of money the federal government has to pay in interest payments, but it's not a permanent situation. And in fact, I would assume that interest rates, are you ready for this, Tom? I think are back below 3% by the end of 2025, if not mid 2025. So you have a period of time where corporations will have to spend a bit more, people will have to spend a bit more, the government spends a bit more. Next 2 years mean, I think, a sideways market in equities. I don't see a scenario where the market really grows significantly unless I'm wrong and we start to get real growth in the economy again. And in that scenario, you're better off with owning high quality bonds paying you a great yield that'll go up in price and as interest rates go down, and owning dividend paying stocks that are going to let you be paid to wait out this period of high interest rates and inflation. Once that trend is our friend and goes back down, then the stock market roars. We're just not there yet. So I'm not worried about it long term. It's much more of a short term next 2 year scenario.
So Phil, we're getting close to our break here, but I do now want to switch gears. I think we're both in agreement. No deep recession, at least through the end of this year, mild at best. I think more of a stag inflation scenario where inflation stays a little bit higher than we want it to be, but the economy neither goes up or grows aggressively nor declines dramatically. One last opinion on that subject?
You know, it's funny when we talk about that scenario. I'm not a stagflation pricing person because I think remember stagflation, prices go higher and growth flattens out. I don't think prices are going to push much higher. I think we're going to get a scenario where they both level out and we see this period of going down. I am a bit worried about disinflation, although it could also be called deflation, but disinflation is where prices fall dramatically because of lack of demand. And we're seeing a bit of that. We'll see places like China and Vietnam and Indonesia and Bangladesh really begin to import deflation to us. Hopefully it gets the Federal Reserve out of the way and corrects things quickly, stop raising interest rates and cuts them. But you got to be careful. I'm more worried about deflation because if you're worth less tomorrow than you are today, it's a terrible scenario and it's just like Europe. So I'm not worried about stagflation. I'm less worried about inflation. We're seeing the trend be a slow burn lower. But if it speeds up because of our demand slowing down because of high prices, we got to fix that quickly. And now you fix it by cutting rates.
All right, Phil, we're going to take a quick break here, and then I can't wait to hear your thoughts on the market so far this year and where do we go the rest of the year.
If you have any questions or comments, please send an email to contact@lebenthal.com. Now, back to the Lebenthal Report.
Welcome back. Phil, so we're going to change gears a little bit. We talked about the fear of the economy and the consumer and businesses and government spending. Let's talk about this crazy market. And I'm prefacing it by using the word crazy. Year to date, the S&P, and these are approximate numbers, up about 14%. The Dow, we'll call it an even 3%. And the NASDAQ over 30%, Phil, over 30%. Crazy, some people would argue, good numbers. But the fly in the ointment, Phil, and I'm looking at RSP, the ETF for the equal weighted S&P, is only up, what, 3-4%, Phil? And if I look at the ETF for the value index, you know what the value index is up year to date, Phil?
Not even 4%.
Nothing. Zero, Phil, zero. What a great market. Half of the S&P, you're up zero. And as some bobbleheads on TV have called it, the fabulous 7 or magnificent 7 or the 10 something or other have pretty much been responsible for most of the gains in the S&P 500. So talk to me about this great market we're in.
Yeah. As of the second week of June, the 10 stocks, there are 10 stocks, and you know them. It's Netflix, it's Apple, it's Microsoft, it's Google, it's Meta, and so on, Salesforce. And those stocks represented 100% of the return of the S&P 500. I have wonderful news. As of today, 20 stocks now represent 100% of the return of the S&P 500. So
that actually is good news, Phil. And I'm being somewhat a little sarcastic, but it is actually good news. Tell our viewers why, please.
So what happened, folks, is at a time when we are in an earnings recession. So in the first quarter of 2023, the average amount of all corporates in the S&P 500 combined together lost money, about 3%. In the second quarter, it looks like the number is called the same, about another 3%. So that's 2 quarters in a row that we saw a contraction in earnings. And we're expecting the third quarter, the quarter we're in right now, we got to average something between 5 and 6%, maybe as much as 8% contraction. And then finally, the fourth quarter might start to grow again. So that you got to scratch your head for a minute and go, wait a minute, let me get this straight. We see corporations making less money, and yet they're going up in price. Okay, so you would assume it's because stocks were cheap. But factually, stocks are not inexpensive. If you look at the price of a company divided by how much they earn, what you're seeing is companies on average are not any cheaper today than they were any time in the last 10 years. In fact, they're a bit more expensive. So why is the stock market, specifically these 20 names and really the 10, up so much this year? Well, there is this euphoria around technology, and it reminds me of 2001, reminds me to a degree post-pandemic 2021, when everything just went straight up. And it reminds me a bit of this idea that the future is so bright, and I want to buy companies regardless of how much they cost, and I want to be a part of that opportunity. And what's different this time is that historically technology companies don't earn a lot of money. But if you look at some of the names that are in this mix, specifically Apple and Microsoft, their profits are really quite strong. They are putting up profitable numbers that are some of the strongest they've ever been at. So something interesting happened, and I, to be quite honest with you, didn't expect it, didn't anticipate it, because the narrative, the playbook on growth stocks is you don't want to own growth companies when the cost of borrowing money, to Don's point before, is going up. Because growth companies borrow a lot of money to grow. They keep investing in the company, investing, new ideas, new factories, new programs, new place to go, new opportunities globally and domestically, and they borrow money to grow. They don't pay dividends generally, and they usually are going to be very interest rate sensitive. So when interest rates are going higher, you don't want to own them, and that's why last year they got clobbered. But something happened last year that even I didn't pick up on, and I regret it, was that they just simply got oversold. It was as if the entire herd moved so hard in one direction that the best names became really good value opportunities. And that would be those names I've already mentioned. So what happened this year, because those names are, believe it or not, almost 40% of the weight of the S&P 500, the old narrative of rising tides raise all boats, because those 20 names, which represent 40% of the entire value of the S&P, have rocketed so much higher, it's lifted the S&P 500. But unfortunately, either you own the S&P 500 index, which you participated in that, or you own those names individually, good for you. If you own anything else besides that, international, small cap stocks, mid cap stocks, value stocks, you've not made any money. But my problem is, this is a very narrow market. And narrow means, if you remember way back in the 80s, we used to have these things called value traps. Companies that paid these big dividends, and then one day they realized they couldn't actually afford the dividend. They slashed the dividend, you got clobbered, and you lost a whole bunch of money. And that harkened back to the banking crisis of the 80s. Now, today, this is not exactly a value trap because these companies do earn money. But let me give you a scenario. Let's assume for a minute that China decides to take over Taiwan, and NVIDIA, one of the names that has really rocketed higher, gets caught up in that stock will get cut in half in a blink of an eye. And then these things tend to have a little bit of contagion with them. If one blows up, more than likely the supply chain in China would get interrupted with Apple and with Microsoft and all these companies that are reliant on China for parts or for services. So in the same way they rocketed higher, I would strongly suggest to the listeners today, take some profits. Finance 101. What everyone does poorly is, when I've gone up a whole bunch, and it's certainly not because of exploding sales and growth, it's about because they were just cheaper than they should have been, take some profits. Take advantage of the opportunity. Take out your initial principal and reallocate it to maybe some, in my opinion, some dividend stocks that haven't gone up this year. Why? Because a narrow market's a dangerous market. It's a speculative market. It's a place that as quickly as it got up, it can come right back down.
So, Phil, I want to expand on that a little bit, but maybe the loaded question first. If we look at the gap between the equal weighted S&P 500 versus the normal S&P that we watch on TV every day, that gap is as wide as we've seen dating back to 2001. I think another critical time in our history where markets had a really, really rough period. does the top come down or the bottom go up? In other words, did that portion of the stock market that has not participated so far this year start to participate the next second half of this year? Do we get some final resolution and the bottom comes up, or do these speculative stocks that have done so tremendously well come down? What's your guess?
Early versus late. For now, come back down. They've got to come back down to earth. In fairness, the names I mentioned are the names of the future. Maybe not Netflix, but certainly, Salesforce, maybe. But NVIDIA from a chip standpoint, and Meta and Google and Facebook and Amazon, obviously Microsoft and Apple. These names are the names of the future. They are their biggest economic drivers. We have their trillion-dollar companies. So they're just very expensive right now. So my expectation is they should come back down. We should give back 5 to 8% on the S&P 500 to get to where we really should be, and those names bouncing back. So expectation over the short term as the Fed keeps hiking rates, let's not forget, July is a pretty tough month. August is the worst month, and the worst month of the year is September. So I think you get clobbered going into September as the Fed keeps hiking rates as we go through the rest of the summer here. But then an interesting thing happens on the other side of September. We get in the October, November time period. Your periods of time with great spending, usually lots of euphoria in markets as we move towards the end of the year. And I think at that point, what happens is interest rates start to come back down a bit. And suddenly those names, those value names that didn't really grow a whole heck of a lot this year start to earn more money because rates have come back down, and they're financing debt less so, and folks are buying goods going into the year. Value names tend to be more goods oriented and less services oriented. The growth side tends to be more service oriented and less goods oriented. So that's part of it in this too as well. But as demand goes into the year for holiday spending, back to school season's a big season. We see their revenue pick up on value stocks. They start to lift. Those growth companies have already been sold off. They start to lift. We end the year plus 15 on the S&P 500, right about where we are right now. But it's a much broader and wider market with much more participation. That's a less speculative market. So I wouldn't expect a heck of a lot from here. But I do think if you want, you could make your value bet and get a nice lift off there to catch up to those growth names, because I do think they come back to earth.
I.e., focus your portfolio to stocks that have not participated so far this year, trim some profits on the winners, use that money to buy some of the ones that have kind of been flat year to date.
Exactly.
You've mentioned it a couple of times. We started the year, earnings on the S&P consensus was, over 230, right, Phil? Right now, the S&P earnings are, I think, consensus around 220, but there are some people out there, very well known, very well respected, that think earnings could drop significantly from here. I've heard one number in the 170 to 180 range by some very well-known people on Wall Street. How do we get earnings to drop that much? And what's your opinion on it?
Consumer would have to fall off a cliff. What's holding us up clearly, 68% of the economy is the U.S. consumer. If we get into a political fight where spending really does get reined in, and we're starting to see that. We're starting to see spending really get reined in here. So if government's not spending, the consumer slows down because of higher interest rates and concerns about this forecasted inflation, we could see earnings drop. I don't think that 170. That would take a 2008.
It would be catastrophic economic.
Yeah, that's not in the cards right now. Not with the amount of wealth that we've created and the debt scenario with the consumer. No, it doesn't seem plausible. But could we go to 205 or 210? That's fair. What does that mean? S&P sells off back to zero. I don't think we have a scenario where we're down 10, 15% like last year because the U.S. consumer is just still too strong and gainfully employed. The real black swan for that to happen would be the unemployment. Boy, let's do some math for everybody. There's 10 million jobs open. There's 4 million people looking. That means there's 6 million extra jobs, give or take. If the unemployment rate pushed back to, call it 5%, we've got a workforce of 162 million people. To go from 3.7 to, make it simple, 4.7% unemployment, a full 1 point move. That means 1.6 million people would have to be laid off from their current job. And we have to eliminate 6 million other jobs that are open. That's roughly 7.5 million jobs that would have to be eliminated. See that scenario happen because we have significant drawdown in corporate earnings and lack of consumer confidence. That's a lot of jobs, Don. That's a whole heck of a lot of stuff.
And Phil, you just threw another one out for us, consumer confidence. We just got a consumer confidence number, pretty good. Pretty
Better
good.
than it was. Not great, but better than it was.
All right, consumers feeling pretty good. When the consumer loses confidence, has that fear factor, that's when they stop spending. I think about what happened after 9/11, where this country was in shock. What happened after the financial crisis in 08, where people didn't know if their money in the bank was safe. People were holding on to their cash with both fists. I'm not seeing that right now, Phil, and I don't know what would cause that.
It would mean people would have to get laid off. But my problem is it's only a small sector of the workforce. There's 330 million people in this country. 162 million are working. We have a participation rate of roughly, it's called 62% because you take out the folks with disability. But that means there's a whole lot of retirees, and the retirees don't care. They're going to go out and spend their money. I bet you most of the folks listening to this podcast have done okay. They saved some money. They're getting a check every month from Social Security. They're getting a check from their pension or from their assets. And they're going out and having fun. Good for them. They should be. Go spend and enjoy yourself. That spending is 25% of global GDP, 70% call it of US GDP, and it's holding us afloat. So the only thing that's going to pull that down, really squash those older folks, is that rates are so high, things get so expensive, inflation keeps pushing higher that they stop. There is one scenario that we should talk about. It doesn't seem to be happening, but there is a scenario where that could happen. And you know what that scenario is, Tom? If the energy markets stop cooperating. One thing we forget is that energy is in everything. Your home, the fuel in the plane, the fuel in the car, the carpets on the floor, the byproducts and the chemicals, the food you eat, all comes back to one single source of pricing power, energy. And if the oil market becomes destabilized because of the war in Russia, Ukraine, or OPEC doesn't play ball, or the United States doesn't play ball, or South America stops pumping, or Nigeria stops pumping, and they all kind of get together and say, we want prices higher because we can make more money, which happened once already in the last 2 years. If that scenario happened where oil went back to $110, $120 a barrel, all bets are off. That's the black swan event. That's when you get a really bad recession and things get ugly pretty fast. But right now, $60 to $70 a barrel oil, sometimes 80. Natural gas at $2.50 a BTU. What you're seeing is energy companies are taking advantage of the opportunity, hiking up rates to make money to take care of their green energy demands, to pay for them because they need to be subsidized because they don't produce enough electricity. But in any event, it's just not a black swan moment in energy. If that changes, then we got a whole nother podcast to talk about and a much worse place to be, because then the spending for the older folks, people do get laid off, and we're in a very bad situation because of a high extended period of time when energy is expensive.
So again, Phil, I just want to move it along because I'm going to run out of time and 50 more questions to ask you. Just spent a little time in Europe. The economy there seems like it's really humming. They are behind us. Inflation's still high. They're still, I would say, 6, maybe 9 months behind us in their cycle of raising interest rates and lowering inflation. But the economy seems like they're moving along. China, not quite the economic growth they were hoping for, but they've just added some stimulus. India is humming along. Global economies seem like they're holding up pretty good.
They're holding up well enough in spite of high inflation, just like us. Let's not forget when we sneeze, the rest of the world gets a cold, as the old saying goes. And that's because of the strength of our consumer. Let us fall into a recession, they'll all get involved. Why is Europe doing well? It's because one, there's been a lack of goods available, but now the goods are available. So that goods sector of their economy is going to turn back down again. And then two, tourism. Europe is the biggest recession in the world.
Restaurants, hotels, travel, airlines. Crazy.
Let things continue to be expensive where the consumer is not willing to pay for it. And that, I have to tell you, that scenario from a pricing standpoint won't last forever. Folks will get tired. They're making their 1 to 2 post-pandemic trips. Maybe there's a third one in there. And I would think it's going to last into next year. But at some point, you'll see that come back to norms. You're seeing flights already at capacity where we were before. Hotels are priced. The pricing power of hotels right now is the highest it's ever been. The price per night in the United States and in Europe. That stuff does get old after a while. And folks are going to say, you know what? Okay, I spent so much on my European vacation. I'm not going to go again until next year because they can get it out of their system. We're in that get it out of the system moment right now. That should change going into, I would think, midsummer, end of summer next year. And that's when those prices should come down and get us back to some sort of normal range of inflation. That's why I think inflation doesn't really break until 2025.
Again, changing gears, Phil, trying to squeeze it as much as I can in. I know you are a big follower of the leading economic indicators. Just give us a quick synopsis. What is that in English, and what are they telling you right now?
So for those of you listening in, if you'd like to do what I do for a living, there's one real easy statistic. It's called LEI, Leading Economic Indicator. It's a 10-factor index that gives you a rolling average of the S&P 500. So it'll look at things like prices of bonds, consumer spending, consumer services, and puts a bunch of data together for you, makes it real easy, combines it all together into a number. And we look at that number, and we look at when it's in expansion mode and when it's in contraction mode. So when it's in expansion mode, it's going higher. Then we have an idea of where the stock market, where's the best place to bet your money in the stock market, and how far away we'd be from a slowdown. When it's going lower, we also have a scenario where what's the best thing to do when it's trending lower, the economy is beginning to contract, what's your best bet, and how far we are from a recession. It's been uncanny at getting recessions right. And what you see is it'll give you an expectation of how far we're away. And right now, what it's suggesting is we're just months away from a recession, that we're probably at the most 6 to 8 months away. Well, this time's a bit different, that you'll see this trend of it, and it kind of has its peaks and valleys, but the trend of it suggests that we're actually already in a recession. What the data says is right now, it's so weak. We're at 4.5% month-over-month LEI and negative 8% year-over-year. That number is usually when we're in a recession. Well, guess what, folks? We're not in one right now. So what's happening, because the strength of the consumers hanging in there, we are seeing a slowing down of the U.S. economy, but not so much that we're in a major contraction mode just yet. So maybe this time LEI is going to say, okay, we slowed down enough, but we're going to start to grow again. And usually when we hit that 8% number is when it begins to reverse and turn around. So in the next few months, keep an eye on LEI. It comes out once a month. You can Google it. It'll come out and you'll see it just came out a few days ago. So let's look at the mid to late July and you'll see it again. And I would bet it's going to show modest improvement because it'll bottom out before the recession happens. That means we probably get some mild recession here or just a real slowdown and we start grinding higher. But it's a great way to keep an eye on things and give you an idea of where to make your bet on stocks and bonds and how bad things really are out there.
So I won't say a crystal ball that actually works, but a crystal ball that has been pretty accurate over the years in forecasting where we are in the economic cycle.
Yeah, I would think that's right. It does a very good job of forecasting where we are in the economic cycle. You know, we want to give you an easy one. I'll give you a real easy one, everybody. You want to know when to get nervous about your money? Keep an eye on temporary jobs. Once a month, we get the unemployment report. There's all kinds of headlines around it. It's all we talk about. And it's a really important number. Usually, unemployment's a lagging indicator. People get laid off after things go bad, not before things go bad. So if the unemployment's ticking higher, it means things are the worst of it's already being felt. But temporary jobs are a leading indicator. So if you look at corporations and how much they hire people month over month for just short-term work, that's a really good preliminary indicator of when things are happening. And we did see 3 months in a row, believe it or not, we saw the month of February, March, and April all be down. And then something happened in May that took us all by surprise, turned back up. 2008, we saw 500,000 temporary jobs eliminated. This year, we saw about 150,000 eliminated, and in last month, we added back about 65,000. So it reversed again. Now, if the trend goes back the other way next month, for the month of June, which we'll find out pretty soon here, well, then that might be a reason for concern to be conservative in your investments. Get out of some of those high-flying tech names, take your profit, rotate to dividend payers or rotate to bonds. Bonds are the best bond market we've seen in a decade or more to take advantage of high-yielding, good bonds that'll go up in price and as the interest rates fall. Or
money market's paying over 5%, Phil.
Exactly.
Well, you
get a CD for 6 months, paying 5.5%, not a bad deal.
Again, we're running close to our, we have a few minutes, but running close to the end. And I hate to save the loaded question for last, but give you plenty of time to explain it. I know you forecast every January. What do you bet on? What do you think is going to happen? Hey, so far, Phil, what'd you get right? What'd you get wrong? What are you going to do about it?
Got a couple wrong, but no forecast should ever be permanent. It's a great way to.
And that's not a slight, Phil.
No, I agree. Look, we forecast because
part of what makes us, I say, good at our job is we know how to adapt. We know how to bob and weave. So let's look at what you were thinking in January. What are you thinking today?
we like to create guardrails to go in, and that's what a forecast does. It gives me the guardrails as I'm driving down the road. So I stay in the center lane, and I might bounce through a guardrail, but it won't keep me from going off the road. First, we thought value stocks were going to beat growth stocks, and clearly they have not. Value stocks, to your point earlier, are not up, and growth stocks are. So that one we've gotten wrong. I do think it's an opportunity to add more growth after this inflationary scare, but for now, that one's not right. But what does it mean? It means we haven't given up on the value story, but we still own quite a bit of growth. So we're tilted towards value, and we're not getting thwarted because of it. We're getting a nice dividend, but it hasn't met my expectation. The idea of adding long bonds, something we're really popular, really in favor of this year. We've added double the amount of the time it takes to get your money back. It's called duration or maturity. So we've done that, and so far that hasn't paid a dividend either, but we haven't lost on that. We've done quite well earning significant yield. We thought international stocks might be an opportunity in the second half of the year, and so far that doesn't look like it. But if the dollar begins to weaken because our economy slows down, let's make a move into international and have some success. We thought the Fed would stop hiking interest rates this year. We actually thought they would do it back in March, and they haven't. So I'd say we got that wrong. But in the end, the idea of rates stopping and going back down was our primary theme, and that's why we want to own long bonds. And that hasn't worked out yet, but we expect that to happen as well. And then finally, we really thought that interest rates would begin to go back down towards the end of the year. And that seems to be the scenario, that we're getting to the high end of the interest rate range to go back down. So no thesis is permanent, but I do think for us the change would be that we'll probably add growth stocks sooner rather than later. If we get a significant sell-off in growth, then we'll add them back in. We've already made the trade into longer term bonds, earning a big yield because of that. We have not looked to go overseas just yet, but keeping an eye on it in case the US dollar weakens, and that gives us the opportunity. That's where we're at today, Dominick.
Well, I think without review, I think you've done a pretty amazing job for your client. You historically have, and that's the guardrail. Don't blow up a client, keep them in the game, and the long-term prospects are usually pretty good. I can't thank you enough for jumping in. We'll have Mike back next week. Can't wait to have you back, Phil. We have lots of stuff to talk about. You're fantastic. You've explained it hopefully in a way that gives our clients a little peace of mind. I appreciate our personal friendship to the company and the show. God bless. Be well. Enjoy your summer, buddy.
Thank you. You as well. Take care, everybody. Have a great summer. Thanks for having me on.